All right, so this is the second part of the lecture where we build up to an understanding of how the EITC operates. But before we get there, we still need to cover further some terminology about how our tax system is set up. And so just bear with me here as we get to the last part of this lecture, which will emphasize the earned income tax credit and how it operates. But first, we need some additional background information. And so first, I'm talking here about just some basic justifications for how taxes might impact low-income populations. I think you could probably reel off a number of different ways in which taxes might have an impact on the populations that we care about. So certainly, in the way of the revenue that we generate, in the way of taxes, those revenues are going to be used for the programs that we operate, that we provide for low-income populations. So there might be a direct impact. The type of tax that we assess, whether it's progressive, regressive, or proportional, that's certainly going to have an impact on low-income populations. Where we set the tax threshold, where we start taxing, where we actually start taxing individuals and married couples and such, that's of course going to have an impact on low-income populations. The type of tax credits that we offer certainly has an impact on low-income populations. So yeah, I think it's a pretty straightforward case here that taxes in many different ways can impact the low-income populations that we care about. Right, so we're building up, like I said, to an understanding of the EITC. And first, just some basic terminology. And I'm referring primarily here to the federal income tax structure and how that system operates. And so we have the notion of exemptions. We have the idea of exemptions and deductions. The basic idea behind exemptions and deductions is that your taxable income. So your taxable income is usually not the entire amount of gross income that you made in the last calendar year. The government will reduce your income according to these exemptions and deductions and figure out what's called the taxable income amount, or the amount of income that the government will actually count when calculating your tax liability or how much you owe. So first we have the notion of an exemption. Exemptions are dependent on the number of people in your filing unit. Okay, so if you're filing your federal income taxes as a single individual, then you just tally up the number of people in your filing unit, which of course is 1 if you're filing by yourself. And so you're entitled to this exemption amount. These are subject to change each year. They're indexed for changes in average wages. But this amount, $3,950, is the basic exemption amount. So if there were 2 people in your filing unit, you would be entitled to 2 times this amount. If you're a married couple filing jointly, you would be entitled to $7,900, and so on and so forth. 3 people, 4 people, and so forth. Okay? And then you have your standard deductions. These are further reductions in your taxable income that Uncle Sam is essentially giving you. And this is dependent not on the number of people in the filing unit, but on the type of filing unit. So how you file your taxes, whether it's as a single individual or a head of household or a married couple, you're entitled to different deduction amounts, standard deduction amounts, depending on the type of filing unit. And so you can see here the different standard deduction amounts depending on how you actually file your taxes. So for a single individual, you're entitled to $6,200 standard deduction amount for 2014. A little more for a head of household if you have dependents, right? The government will give you a little more of a break here. And then if you're filing as a married couple filing jointly, the government, it's thought that one of the advantages to being married is that you're entitled to a greater standard deduction, and that certainly is apparent here, right, in the way of the standard deduction amounts. The government gives you additional reductions in your taxable income depending on certain expenses that you've incurred in the past calendar year, things like your charitable contributions, right? Any donations that you've made to 501c3 entities or nonprofit entities, those are deductible, right? So further deductions in your taxable income. And you can think about why the government would do such a thing. It's to encourage certain behaviors in some circumstances. And then things like medical expenses, moving costs, certain expenses that you've incurred, that the government will essentially give you a break for those types of expenses. You may have heard of people talking about their tax write-offs, expenses incurred that can reduce the amount of taxable income. There's lots and lots of different categories of tax loopholes that individuals are entitled to. And so you have basic reductions in the amount of income that the government will count when calculating your tax liability or the amount of taxes you owe. Okay, and so that's those are exemptions and deductions. All of that, I'm saying all of that to give you an understanding of when the tax credit actually comes into play. Okay, so the tax credit doesn't come into play until the government actually figures the amount of taxes that you owe. And so we apply the exemptions, we apply the standard deductions, we apply the calculated deductions to figure your taxable income, which in turn is used to figure out how much you owe in the way of taxes, your tax liability, in other words. And it's at that point at which the tax credit actually comes into play. Okay, and so tax credits can be either refundable or non-refundable, I note here. And certainly, if you're thinking about low-income populations, if you're thinking from that perspective, so certainly refundable tax credits are going to be more advantageous to low-income populations. And that's because low-income populations have very little to no tax liability typically. So low-income populations are going to owe very little in the way of taxes usually. And so if you have a non-refundable tax credit that's applied to almost non-existent tax liability, that does you no good, right? And so somewhat commonsensical, but certainly we want refundable tax credits for low-income populations is the point here. So taken as a whole, you have exemptions and deductions that reduce the amount of taxable income, the amount of income, in other words, that the government will count when calculating your taxes. And then you have tax credits, which are applied to your tax liability, right? Once the government figures the amount of taxes you owe, that's when the tax credit kicks in, okay? All right, and so here I'm showing you how the tax is actually calculated, or in other words, the marginal tax rates, the tax rate on the next additional dollar that you've earned, right? Or another way to think about it is in terms of the tax bracket. This is the tax bracket in which individuals and families reside. But you'll note here at the lowest rate is the 10% tax bracket. So on the first dollar that you earn, you have separate columns for single individuals, married filing jointly, for heads of household, which I don't include in this schedule. But let's look just at this column here for a second to see how the income tax structure, to see how these taxes are assessed. So on the first dollar that you earn, you're going to get taxed 10%. Okay, and so this is actually looking at taxable income, right? So after applying exemptions and deductions on the first dollar of taxable income, right, you're going to be liable for 10% or 10 cents. On the second dollar of taxable income, you're liable for another 10 cents. On the third dollar, another 10 cents, and so forth, right? All the way up to dollar taxable income in the amount of $9,075. That's the first bend point, we call it. On taxable income of $9,076, on that $9,076, you're going to get taxed at 15%, right? So we see a shift in the tax rate. On taxable income, $9,077, you're going to get taxed at 15%, all the way up to the next bend point, right, of $36,900 of taxable income, at which point, on $36,901, you're going to get taxed at 25%. That's essentially how our tax brackets are set up. Okay, so I'll give you an example here to illustrate those ideas. So we're taking a single individual, right? The hypothetical here is of a single individual with no kids. And in terms of taxable income, let's say this person has taxable income of $50,000. So this is after we apply the exemptions, we apply the standard deductions, and any possible calculated deductions. This person possesses $50,000 of taxable income. And so you'll note that this person will pay 10% of the first $9,075 of taxable income. And I show you the exact amount in parentheses. This person will pay 15% of the difference in the next bend point. So the difference between $36,900 and $9,075, which comes out to $27,825. This person will pay 15% on that difference, on that amount, right, which I note here. And so the actual amount of tax paid is in parentheses. And then anything in excess, so I'm looking at taxable income in excess of $36,900 will be taxed at 25%. And so this person has $50,000 minus $36,900 in the way of taxable income in this tax bracket. 25% of $13,000 in parentheses. If you add those amounts up, the total tax that this person is liable for is $8,356.25. Okay, and so that's how we calculate the individual tax liability for this hypothetical person. I distinguish here between actual and marginal tax rates. So you'll note that in terms of the marginal tax rate, or the tax rate that's applied on the next additional dollar, this person is in the 25% marginal tax rate, or that particular tax bracket. But the actual tax rate for this person is going to be different because of the way in which we calculated these taxes. And you'll note if you take the total taxes paid, right? We just noted that this person paid $8,356 in the way of tax as a proportion of taxable income. It actually comes out to 16.7%, right? 16.71%. That's different from the marginal tax rate, or the tax bracket in which this person resides. And so note that there's a distinction between actual and marginal tax rates, right? And so when you hear of wealthy individuals who they should be paying 40%, right? That's our highest tax bracket. 39.6% is our highest tax bracket. They should be paying 40%, but because of all the deductions, both calculated and standard, and exemptions, all the different tax loopholes that are applied, the actual tax rate may come out to much lower than the marginal tax rate in which the individual or their family may reside. Okay? And so here, you can run this example by yourself to see how well you understand these ideas. But yeah, so this is exercise 2. I'll let you guys do this on your own. And so in the next part of this lecture, we'll actually dive into the EITC and see how this program operates.